Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 353 on December the 13th, 2024. I'm your host, Eric. And in this week's show, we'll cover the trades from last week on GameStop Corporation, Citigroup, and Rivian Automotive. And we discuss three new trades on Lucid Group, the KraneShares CSI China Internet ETF, and Robinhood Markets. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets finished the week lower, but still very high. The Dow Jones Industrial Average lost 814 points, closing at 43,828 points on Friday. The S&P 500 index lost 39 points, ending the week at 6,051 points. And now it's time for the topic of the week. The topic of the week is my long bias. If you've listened to the show for any length of time, you'll notice that 95% or higher of the episodes, I make trades that have a long bias, meaning they are biased towards the market going higher in price. When I use the word long, it's trader lingo for being bullish or buying the market. You make money on a covered call when the market goes higher in price. You make money on a long call spread when the market goes up in price. You also make money by selling a put spread when the market goes up in price. Occasionally, someone will email me to ask the question about my long bias, and I'm actually surprised that doesn't happen more often. Now, as a trader, you should acknowledge and understand any biases that you have about the market. I once spoke to someone who said they only knew how to trade puts. Someone else only knew how to trade calls. That's a bias. So why do I have a long bias in my trading? Well, most people who are active in the stock market are only comfortable buying stock and expecting the price to go up. Very few get comfortable selling a stock short and profiting when the price goes down. So that's one reason for my bias. Another is that every year, several million 23 to 25-year-olds get full-time jobs and put a portion of their income into a 401k. Nearly all of the 401k investment choices involve a buy and hold strategy for stock, once again supporting my long bias. Now, I'm well aware that markets crash. I witnessed the crash of 2001 firsthand because I was a new trader at the CBOE in Chicago. I witnessed the crash in 2008 firsthand because I worked for an investment bank that likely might have gone under had it not been bought by another bank. This podcast was already live during the 2020 pandemic crash. In each of these scenarios, the market went down for a brief, traumatic period, followed by an epic rally in price. That doesn't always have to happen, but it further supports my long bias. Now, keep that sort of thing in mind as you plan out trades for the short and long term. Since we are trading at all-time highs right now, it's hard to get excited about buying even higher. I do think there's a decent likelihood that we'll see a market crash in the coming years. I also think that there's a high likelihood that the market will rally after that crash and make new highs. There is a constant supply of money coming into the market, supporting stock prices going higher. And until that changes, consider me a Parma bull who occasionally thinks the sky is falling. All right, so that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. We're going to start off with our covered call on GameStop Corporation, symbol G as in golf, M as in Mike, E as in Echo. At the time, the stock was trading for $29.02 per share. I looked at buying stock and selling the December 29 half call at $2.73, hoping for a return of 11.06% in 2 weeks. Well, shares of GameStop fell $1.02 per share, ending the week at $28 per share. The option that we sold lost $2, leaving us with a net gain of 98 cents on the week if we were to close the trade out immediately. Now, typically, if a stock moves against us, it's a bad thing. But that call option we sold was so juicy, we've still made money on the week. The call price was 9.4% of the total stock price, and it looks like that's going to expire out of the money. That's great. Along with that, the stock price is still above our break-even point, so this is overall a profitable trade. Now, I would lean towards not making any adjustments unless you just want to take the profit off the table now by closing the entire trade. But this option will expire worthless on Friday if the share price remains below $29.50 per share. That will allow you to sell another call against that stock in the month of January on the following Monday, December 23rd. It's important to remember to let the option expire worthless. Do not roll it by buying it back and then selling the January call. I like to keep every possible cent of profit on these trades, and rolling the trade will eliminate some of that profit. So, no adjustments are needed at this moment. The trade is working out just as planned. Next up, we had our credit spread on Citigroup, symbol C as in Charlie. At the time, the stock was trading for $72.13 per share. I looked at selling the December 72.71 put spread at 36 cents. That could give us a maximum possible loss of 64 cents per spread. Well, shares of Citigroup lost $1.12, ending the week at $71.01 per share. The out-of-the-money put spread that we sold is now in the money. In fact, we are 1 penny away from a total loss on this spread at expiration. Now, you could sell the 72.73 call spread, which would turn this into an iron condor, but that will only gain you an additional 9 cents. You could actually close the entire trade for a loss of 19 cents right now, which will save you from losing a total of 64 cents if the stock were to expire here. The one news event that might correct this trade is the Federal Reserve Bank interest rate announcement on Wednesday. A rate cut might push bank stocks higher. That would support this trade and allow you to finish with a winning trade without making an adjustment. So, do you lock in the 19-cent loss or decide to wait for the interest rate announcement on Wednesday to see what the stock does? Part of being a trader is finding a way to manage that uncertainty. The main way I manage is simply by trading spreads. I was willing to take that 64-cent loss when I entered this trade. I sized the trade accordingly. It might be worth waiting. Risk management is always a very personal decision based on the size of your account, your willingness to take a loss, among other things. Either way, this trade expires in 5 days, so keep track of the stock and do your best to always limit loss and lock in a profit if it's there. Our final trade from last week was a debit spread on Rivian Automotive, symbol R as in Romeo, I as in India, V as in Victor, N as in November. At the time, the stock was trading for $13 per share. I looked at buying the December 12/2 13 call spread for 30 cents. That could give me a maximum gain of 20 cents, or that's a 66.67% return in 2 weeks. Shares of Rivian Automotive grew $1.37, ending the week at $14.37 per share. The in-the-money call spread that we bought is now even more in the money. And with options expiration 1 week away and the stock more than $1.50 above our break-even point, this trade is looking like it's going to be a success at expiration. So no adjustments are needed right now. You do have to keep track of the stock price over the next 5 business days and make sure you have a plan for if it moves against you. So that's it for the trade review from last week. Just wanted to remind you, the expiration for monthly options in December will occur in 5 business days on Friday, December the 20th. Another event to keep on your radar, be aware of, is the interest rate announcement on Wednesday, December the 18th. Now, all new trades on today's show will use the January 17th expiration for monthly options in January. So let's get into the new January trades. We're going to start off with a cover call on Lucid Group, symbol L as in Lima, C as in Charlie, I as in India, D as in Delta. The stock ended the week at $2.58 per share. I'm looking at buying that stock and selling the January 3 call at 17 cents, hoping for a return of 22.87% in 5 weeks. Now you enter this trade by buying stock for $2.58 and concurrently selling the January 3 call at 17 cents. This trade makes the most money if stock prices finish above $3 per share, and the break-even price is $2.41 per share, In real terms, the stock purchase would require $258, and you'll collect $17 for selling the option. Next, we have the credit spread on the KraneShares CSI China Internet ETF, symbol K as in kilo, W as in whiskey, E as in echo, B as in Bravo. The stock ended the week at $31.72 per share. I'm looking at selling the January 31/30 put spread at 38 cents. That could give us a maximum possible loss of 62 cents per spread. Now you enter this trade by selling the January 31 put at 94 cents and concurrently buying the January 30 put for 56 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $31 per share. The break-even price on this trade is $30.62 per share, and in real terms, you'll receive $38 per spread that you sell and have $62 at risk. And our final trade on the week is going to be a debit spread on Robinhood Markets, symbol H as in hotel, O as in Oscar, O as in Oscar, D as in Delta. The stock ended the week at $40.20 per share. I'm looking at buying the January 39/40 call spread for 55 cents. That could give us a maximum gain of 45 cents, or that's an 81.82% return in 5 weeks. Now you enter this trade by buying the January 39 call for $3.80 and concurrently selling the January 40 call at $3.25. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $40 per share. The break-even price is $39.55 per share. In real terms, you'll pay $55 to enter the spread, and your maximum gain is $45 per spread. So that's it for this week's show. As always, I am thrilled to death that you guys listen. Thank you for listening. Thank you for sending in the emails. You guys are awesome, and I hope you have a wonderful weekend. As always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.